Dubai is booming again. Apartment prices are hitting historic records, demand is huge, and projects are selling out even at the off-plan stage. It was almost the same back in 2008, and then the market collapsed. So, could history repeat itself in the upcoming 2026? In this video, we'll break down where the real risks are hiding and where, on the contrary, huge opportunities still exist for investors. And by the end of this video, I'll show you which areas could cost you money and where you can still realistically grow it. To understand what to expect in 2026, we need to go back to 2008. On the screen, the price chart from that time is highlighted in color. Back then, Dubai went through its only real crash. Prices collapsed by almost half. Why? First, the market was overheated with speculation. People were buying apartments just to resell them a few months later. Second, banks were giving out loans of up to 120% of the property's value. You could borrow not only for the apartment itself, but also extra for renovations. Third, developers were selling projects off the drawing board without even owning the land. On a single street, dozens of towers were rising, but half were never completed. The result? Debt, panic, and a mass exodus of expats. Remember those famous photos of abandoned luxury cars? That was a direct consequence of the crisis. Many speculators abandoned their cars and fled the country to avoid paying huge debts. A lot has changed since then. After the crisis, the authorities introduced new rules to protect investors. First, mandatory escrow accounts. Now, money cannot be withdrawn from the account and spent on anything other than construction. Second, the requirement to own the land 100% before starting construction. To sell a project at the construction stage, a developer must fully own the plot, complete at least 20% of the building, and record these expenses in the state escrow account. And most importantly, the funds from the account are transferred to the developer only after the construction is completed. All these measures significantly reduce investment risks and make Dubai's market highly attractive and liquid. After the 2008 crisis came a new period, 2011 and 2012. This was an important stage for Dubai's real estate market as many projects launched in 2008 with government support started being delivered. They offered Dubai a lifestyle it had never seen before. For example, Arabian Ranches, Emirates Living, Palm Jumeirah. All these mega projects began generating profit and lifting the market again. This led to the organic growth of the market up until 2013 to 2014. You can see that from this point, the market started to grow even faster. Yes, today Dubai has strict regulations and transparency, but what happens if hundreds of new projects are launched at the same time? Today's situation is very reminiscent of 2015. Back then, the market was growing rapidly, but developers launched too many projects. When they started handing over the units, supply sharply exceeded demand and prices went down. Now we're seeing a similar picture again. Thousands of apartments are being built off-plan. According to forecasts, by 2026 a record volume of housing will be delivered, especially in the JVC and Business Bay areas. To give you a sense of scale, JVC alone will account for about 10% of all new apartments in the city. And this is where it's important to think, is there real demand in these specific locations? After all, overheating doesn't start with a nationwide collapse, but with an oversupply in particular districts. But there is another side. COVID changed the rules of the game. When Europe and Asia shut down, Dubai opened its doors. The city saw an influx of Europeans, entrepreneurs, and families seeking safety and stability. This gave a strong boost to the market. Demand surged for premium waterfront apartments and family villas. A simple example, in 2019 it was easy to get into Dubai's international schools, but today many of them have waiting lists of up to 2 years. However, there is a nuance. Demand is growing in the upper segment, while mass market housing may end up in oversupply. And it is precisely in this gap between premium and mass market where the main risk of 2026 lies. So will the market crash in 2026? My opinion, no. There won't be a collapse like in 2008. The system is too resilient and demand is global. But that doesn't mean the market will grow endlessly. With high probability, we will see a correction. a slowdown, or even a drop in prices in certain areas, especially in those with many cheap projects and chaotic development. This won't be a crash, but rather a redistribution. Premium locations will continue to grow while the mass market segment may decline, and the investor who bought anywhere risks losing. And remember, real estate appreciates when land appreciates. Thank you for watching. This was Omar. See you next time.